Tax Care. It's not a name, it's a promise.
With the sole proprietorship business, you pay all the taxes on an individual level. Social Security and Medicare taxes. The whole point of having a corporation is that it saves you Social Security and Medicare taxes. It limits how much you pay into that. For example, I'm going to use an example of about $100,000 profit. This is after you take all of your income and write off all your expenses. You're left with, let's say, $100,000. As a sole proprietorship on the Schedule C, you would have to pay regular income tax on this, plus you would have to pay...
So this is based on your operating profit?
Yeah, this is on your operating profit. This is after all expenses. You take your income, subtract the expenses from it. So on Schedule C, you would pay 15.3% after you take your regular income tax rate.
Mm-hmm.
So it would be $15,300 on this number here, on $100,000. The whole point of setting up an S-Corp is to limit how much you pay into this tax, this self-employment tax. This is called self-employment tax. Now, before we get into how it limits what you pay into self-employment tax, first we're going to talk about how a W-2 works. You've worked on a W-2 before. You know that you pay into 5 taxes as an employee. What you don't realize is that your employer also pays 5 taxes in California.
Okay.
So the 5 taxes that you pay, out of the 5 taxes, 2 out of the 5 taxes is what self-employment tax entails.
Okay.
As an employee, and for the employer, 2 out of the 5 taxes that they pay is what constitutes self-employment tax as well.
Okay.
Now, out of those 5 taxes, do you remember what you paid on withholdings?
You mean the actual titles? Or
Yeah.
Medicare, wasn't it?
Okay, good.
Social Security?
Okay.
Is there a disability one?
Yes, this is SDI versus California.
I don't remember that.
Okay, and then so the other 2 is very simple. It's what we do at the end of the year when we file your taxes.
Oh, federal.
Federal?
Yeah, and state, yeah.
And state.
Yeah.
So these are the 5 taxes that you pay.
Yeah.
Out of these 2 right here, self-employment tax is basically it covers these 2 taxes right here. Mm-hmm. So this is 1.45%. This is 6.2%.
Okay.
This is for the employee, right? Employer also pays what you pay into Medicare, and they match it. Now, if you take these 2, this comes to 7.65%, and this comes to 7.65%. Now, if you take 7.65%, you multiply it by 2, that's 15.3. That's where you get this. This equals self-employment tax. Mm-hmm. So, since you don't have an employer and you're not working on a W-2, the whole point is that IRS wants you to pay into this Social Security and Medicare tax system. But with the sole proprietorship, just like an LLC, it's all subject to self-employment tax. One of your questions was before we started your corporation, was which one is better, an LLC or an S corporation?
That's right. Yeah.
And so this is going to answer that question as well. Because an LLC, all of the profits it makes, it's also subject to Social Security and Medicare self-employment tax.
Okay.
However, with an S corporation, just like an LLC, it receives a K-1. With an LLC, game over after K-1. That's the only income you report on through a pass-through entity LLC. You don't have to report any other distributions other than the K-1 because the K-1's all subject to self-employment tax on an LLC.
What's K-1 again?
Okay, K-1 is the Schedule K-1 that we use in order to bring all of your profits from the corporation to the individual tax return.
Okay.
So, for example, all these entities, trust, LLC, S corporation, partnership, general partnerships, they're all pass-through entities. What it means is all the income that it produces, it passes through onto the individual tax return, onto the partnership return, onto the shareholders return. It doesn't pay any taxes on the corporate level or on the entity level.
C Corp would be...
C Corp would, exactly.
Yeah,
C Corp would pay taxes on the corporate level.
Okay.
But with an S corporation, it passes all of those taxes to the individual. Now here in California, we have to pay 1.5% user fee to use a corporation in California. So the only tax per se you would be paying is 1.5% on your profits. Okay. So on this, for example, would be $1,500 user fee. The minimum that you pay to California is $800. So they wouldn't accept anything less than the minimum. The first year they give you 1.5%, but let's say the year after that, you still make a minimum income, they would still require you to pay the $800 user fee.
Got it.
First year, they'll allow you to pay with 1.5%, the lesser amount. So with an S corporation, you get two sources of income. You get the pass-through income on a K1, and you get a W-2. And the reason why you also get a W-2 is because the K1 on an S corporation is just like the dividends you receive from the bank. It's passive income. It's not subject to self-employment tax. It's impossible to make it subject to self-employment tax. It just isn't. So IRS says, well, since this is all considered passive income through an S corporation, we also want you to take a W-2. Just like how when you receive stocks from Microsoft, you receive dividends from it, and now you report that dividend on your your income tax return. K1 works like that. Now, since you're an employee of your own corporation, you take distributions on a W-2.
Okay.
The K1, think of it just as your dividends, as the profit that you're making from the corporation. Whether that dividend stays with the company or it gets distributed to you, you still pay taxes on that dividend.
Okay.
So now we have a W-2. So on this W-2, now let's say we still go back to the $100,000 example of income. On this W-2 right here, we're going to take, let's say we're going to take 30,000 on here. 30, 36, 40, whatever you want. But the idea is that we don't want to put too much through W-2, because the more you put through W-2, the more you pay in Social Security and Medicare taxes, and the savings is minimal at that point.
Okay.
So now we'll take 70,000 here on the K1. Now remember, this is regular. It's just subject to regular tax rate.
Okay. That's gonna be the 15% then.
This right here is just a regular income tax rate based on your tax bracket. That you're in.
Okay. Okay.
This one right here is going to be subject to the 15.3% plus some other minimal payroll taxes.
Okay.
The majority of it is the 15.3. Real quick, the taxes that you're going to be paying here. I'm not going to talk about federal and state. We're going to worry about that's within the tax rate that you're going to be paying. But what you are going to be paying is Social Security, Medicare. Remember, this is the 15.3%, right? As an employee and as an employer. And now you also pay your FUTA, Federal Unemployment Tax Agency. This is 0.6%. This one right here, SUI, in the state of California, will pay state unemployment insurance. This is usually 3.4% at the starting rate. Could go down as think of it as your insurance policy for any unemployment claims that your employees take against you. The more claims you have, just like if you get in an accident in your car, and if it's your fault, your insurance rate goes up. Or if there's a fire in your house, your insurance rate goes up.
Okay.
If there's more claims against you on unemployment, your SUI rate goes up. State unemployment insurance goes up.
Okay.
But if there's no claims against you after several years, this 3.4% could actually go down too.
Okay.
So, and then there's ETT. This is employer training tax, which is 0.1%. These three taxes, they stop after the employee earns $7,000 of wages. In one calendar year, if that employee reaches $7,000, you don't pay these taxes. These are all three of these taxes right here consist of the 3 out of the 5 taxes that the employer also pays. So they stop at $7,000, which means about $250 a year.
Okay.
You don't pay these taxes after $7,000, so it's going to cost you about $250 in taxes per year for these 3 taxes.
So you mean it caps at 7,000? So if they make like 9,000, it's still going to be the 250.
Right, and
okay.
it stops there.
Got it.
So if they make 7,001, that $1 is not taxable with
Got
these
it.
3 taxes.
Okay.
And then of course you have the employee pays. You said it before, SDI, disability insurance, in case an employee gets hurt on the job. There's a state disability insurance fund that pays for the temporary disability insurance.
Okay.
This one right here is 0.9%. So if we're really looking at the numbers, we're going to take this plus this and say you're going to pay 16.2%, because this 250 really is just not that. It's so small, it doesn't really matter. So you're going to say about 16.2%. Would you rather pay $15,300 or $4,860 based on the $100,000 net
Yeah,
profit?
48. Yeah.
Right. So that's how you would do it. You're satisfying the IRS's request of you paying into taking a distribution on W-2, and you're saving money in taxes. You're limiting how much you're paying into that Social Security Ponzi scheme, right?
Got it.
That's the whole idea of it.